the first point I wanted to make was that there is an incredible change taking place across the investment industry, and that's affecting all parts of it, including index investments as well. I mean, back when I joined FTSE back in 2002, this was a pretty niche area, small number of kind of ethical retail funds. Institutional investors weren't really interested. Today, it's completely different. As some people might be aware, you get some very big figures here. $30 trillion of assets now take some kind of sustainable investment approach into account. That's about a third of professionally managed assets. That's projected to be about, to get over 50% by 2025. And what's driven this has been asset owners, so the big pension funds and the sovereign wealth funds, really wanting to try and integrate this across all of their investments. And it's been them pushing effectively the asset managers to really sit up. As asset managers have lost mandates on this basis or won them, this has led to incredible changes across asset managers as well. And as it hasn't reached passive until more recently. So index funds have still typically followed broad benchmarks, but over the last few years, this has really started to shift as well. It's reflected. We do a survey every year of asset owners, and one of the questions we ask is to what extent they integrate ESG, and this has shifted over the years. This is particularly looks at integrating ESG into index funds. So this is no longer a small part of the market. This is the market. So 72% globally, this is of 140 asset owners, said that they've either implemented or are looking to implement into their index funds. That's higher in Europe, 85%, but it's a majority in the US, 63%. And following the election there, we're going to see that go much further, I think, with the Biden administration. This also reflected in our own experience. Now, a majority of new index mandates, institutional index mandates in Europe, now want to incorporate ESG and often climate. Climate's usually the main piece of this. This isn't just the public pension funds. This is increasingly the corporate pension funds. One of the first movers here 3-4 years ago was HSBC bank pension funds, who, for their default option for their defined contribution scheme, we took on a climate tilted index rather than a broad market one. So I think it brings me on to the second point, which is that the world of index investing and passive investing is changing hugely, and most companies have got no idea that this is taking place. To give you a sense of what this really means, is this is typically taking very kind of broad benchmarks and then applying a range of climate factors to overweight and underweight securities, depending on how well positioned they are on climate. So the kinds of things we're looking at, things like carbon emissions intensity relative to sectors. We're looking at exposure to fossil fuels, to the kind of, there's a lot of debate about stranded assets, exposure to green industries relevant across all sectors. What level of revenues from solution products and services. This is looking at what kind of climate strategies companies have got, and what kind of forward-looking targets. How well aligned are they going to hit the kinds of emission reductions over time that we need to see to get down to the level of emissions to achieve no more than 2 degrees of warming. So there's a whole variety of metrics we're using, but often companies are not disclosing the right information. And often what that means is that investors will assume the worst. So it's really important to disclose. There's also, I think, this disconnect between the asset owners and investors. Asset owners and the corporate issuers. And I think there's a real understanding about what's happening here. So there's often a real kind of view that a small number of sell-side analysts really represent the whole of the investment chain. And obviously they can be very important, particularly for the active investors. But these index funds, which represent a very large proportion of institutional investments, these will be tilted on the basis of data that's disclosed through annual reports, sustainability reports. And I think most companies have got no idea really where that information is going. And that is influential. It is affecting investment flows. So it really just brings me on to the final point, which is that it's just so important for boards to understand the level of change that's taking place here. This isn't just about oil, gas, and mining sector, as important as everything that's going on there. But I think the visibility there is very high, and there's a high level of engagement with investors on it. But this is relevant across industries. And companies need to be proactive on this agenda and to really set out what their strategies are, how they're managing these risks. What we're doing at London Stock Exchange Group, because we kind of sit between these worlds, on one hand, we're supporting investors with the kind of tools and the data. We're also supporting issuers who are trying to navigate this. We're planning to bring a lot of tools for companies over the next year ahead of COP26 in November. We're also doing some working with exchanges around the world to develop consistent guidance on climate reporting based on TCFD. That's the Task Force on Climate-Related Financial Disclosure. You're probably aware that there's obviously regulation which will be moving into place here as well in the UK and elsewhere. But I think exchanges can help issuers understand this, navigate it, and start reporting on this more quickly.